Hi, everybody. I'm Eli Noff from Frost Law. I'm a partner here, and I practice heavily in the international tax compliance area.
For Americans abroad or any resident American who has activities going on outside the United States, when you see the word foreign in the Internal Revenue Code, there's likely a penalty, but there's also very likely to be a requirement of letting the IRS know what you're doing. Would you agree with that?
I agree with that. If there's foreign activity, you should consult a tax professional as to what obligations that creates and not do cursory internet research. Well, I think it's always good to educate yourself, but not to hang your head on conclusions based on a 10-15 minute Google search. Pick up the phone, try to confirm it, call John, call myself, and we can have a discussion regarding whether there's something to be concerned about, because doing it wrong and perpetuating a problem for many years can result in what John's alluding to is really significant penalties and compliance problems, and part of today's discussion.
Absolutely. Well, let's start off with, and I think we've discussed this before, that when people think about a U.S. tax return, I sort of see it as two broad categories. The first are things that have to do with how much tax you owe, the actual numbers. And the second would be information returns that, at least at present, probably don't have a lot to do with how much tax you owe, but certainly provide a role in creating information, a background source of information on you. Would that be correct?
Correct. There's some informational reports international informational reports that do feed into the tax, and there are some that just simply don't, and they're informational in nature, such as the FBAR, such as the Form 3520, which is somewhat of the big one out there in the media today. It's the Form 3520 where you report any activity or certain activities with a foreign trust, but more importantly, and what we see a lot more, is U.S. persons receiving gifts or inheritances from foreign individuals greater than $100,000. And that triggers an informational reporting requirement that, if you miss, carries a 5% penalty per month on the foreign gift or inheritance and caps out at 25%. So once you're 5 months late, you're looking at a 25% penalty on that foreign gift. And I've seen some pretty big ones, some whoppers.
Right. So far, they're not. But just to put that in context, what you're describing, if you confirm, would be a situation as common, as pedestrian, as inheriting a piece of real estate from a relative abroad. Would that be accurate?
Correct. Inheriting really any asset greater than that $100,000, not individually, but in the aggregate. So you look at everything you're inheriting. It's rare that somebody inherits just a piece of land. There's usually some form of financial asset associated with it as well. But if not, then you would look correct. You would look at what asset was inherited, whether it's cash or otherwise, get an appraisal, and go through that process.
And this would presumably also include a situation where a U.S. citizen was living outside the United States and was married to a non-U.S. citizen and received a gift or a transfer from that spouse. That would also trigger this, wouldn't it?
Correct. I mean, I don't see why it wouldn't. During lifetime, the IRS treats gifts from spouses as reportable events if they're non-residents or non-U.S. persons. Then, in death, it would be very similar.
Mm-hmm. So I think that the key point that needs to be stressed here is that these rules kick in very normal situations where it's perfectly common, for people to receive transfers from somebody. And what triggers the requirement is just the fact that the person you're receiving it from is not a U.S. citizen or resident alien. Is that correct?
That's correct, meaning it's a very benign fact pattern that is common to many people living abroad. However, it creates these obligations that have such significant penalties for non-compliance.
Right, and even for Americans abroad, leaving aside the FBAR even, there are all kinds of requirements to report, mainstream foreign financial assets, including, I believe, just normal pension plans from employment. Would that be correct?
In certain circumstances, pension plans can create a host of filing obligations, FBAR 8938, 3520, maybe 8621s. It just depends on the nature of the pension plan for purposes of determining what the right form in informational reporting would be.
So, I mean, it seems to me it just goes on and on and on.
Yeah, I would love to see more exemptions. I mean, the IRS did come out with a notice, I think back in earlier 2020, that took a really good stride in trying to exempt certain foreign pension plans from some of these onerous reporting requirements. And it was a great step, and you've got to give the IRS props for hearing us. But it had these criterias that had to be met that were so nuanced that some filers don't even know if they meet those criterias, and they reach out to the pension system, and they're not giving them the information necessary to make these determinations. Perhaps maybe less narrow scope, maybe something a little broader would be helpful to have in the future. But it's good to see the IRS engaging in some form of relief, and we hope that through efforts of attorneys across the country and other tax professionals, that this will continue to soften up. But of course, it's an uphill battle, and nothing happens in lightning speed.
Well, that's right. I mean, I do agree with you. I think you're referring to Rev Proc 2017, which was a very good step forward, both in intention and recognition of the problem. And I think to some extent, in effect, I mean, I do feel for the IRS having to draft these things without having, a really good understanding of how financial and retirement planning operates outside the United States. But I had a thought on that I'd like to run by you. With all the FATCA IGAs, they all contain exemptions for things that are basically, company pension plans or financial planning, tax-deferred vehicles in other countries. And so in a sense, Treasury, by entering into all these IGAs, has already done the research for the IRS, I think, in determining what those plans are, that really have, that could never be construed as having anything to do with tax evasion. What would you think about another Rev Proc or an amendment to it, if that's possible, simply saying that, if this is something that is exempt from reporting under the FATCA IGAs, then no 3520 is required?
Look, any guidance from the IRS that further limits and narrows the scope of what's required to be filed and limits the onerous filing requirements, I think is welcome in the tax community, right? Both for professionals like us and for taxpayers, because at the end of the day, we all suffer from it. Because clients come and maybe there's a $50,000 pension account, and we have to spend so many hours trying to deconstruct what the filing requirement is. I mean, when you look at the cost benefit of coming into compliance, it becomes hard for taxpayers to really justify, reaching out to a tax professional to come into compliance, because they're calling around and they're getting quoted all these fees. Well, if you have this type of account, we've got to spend this many hours looking into it, and this, right? And sometimes the juice isn't worth the squeeze, so to speak. And when you look at the tipping scale of how much money there is to report, I mean, it's really creating situations where people can't figure out how to come into compliance on their own and are just making best guess judgments on how to do that.
Well, absolutely. I mean, I think that there's a very, very large number of taxpayers who simply they just don't have the money for the advice.
I agree with you. I agree. I think it's very pervasive. I mean, I wish I could fix everybody's tax problems, right? But unfortunately, when you're running a business, you've got to create, certain barriers to entry. And I receive a lot of calls, and I try to steer them right and give them as much information as I can to put good energy out there in the world. I believe in that, and people call me all the time, and I take 3 calls every day. But I try to give them as much information as possible to educate them, and in certain circumstances that might be enough. But in other circumstances, it might be such a complicated issue that how are you going to go and educate somebody on how to do an 8621 PFIT computation?
It's completely impossible. It's
Right,
completely impossible. I agree with you. Terrible problem. But hopefully podcasts like this will create somewhat of an educational environment for people. At least that's my hope. And you're doing a great job with this. Okay, so working with a statute. So we have the statute itself, the Internal Revenue Code, that creates the information return requirement. Why don't we work with, let's work with the Foreign Trust, which I think is Section 6048 of the Internal Revenue Code. Now, and there are a number of other of these sections. 6038 would be the 5471. 6038D would be, I think that's the Form 893A. But generally speaking, what these statutes say is that there's a penalty normally, well, not in the case of 3520, but say $10,000 unless you can demonstrate reasonable cause. Now, without getting into this in too big of a way, is it even fair to ask for a short clip on what reasonable cause means?
Loaded question right there. The standard is reasonable cause and not willful neglect, right? And I think you focus in on the reasonable cause, and it's a ordinary business care and prudence standard. And look, the way we look at reasonable cause and the way the IRS looks at reasonable cause has been diverging, particularly with the Form 3520 penalties that we've been seeing go up to appeals, and the harsh stance appeals seems to be taking towards reasonable cause, where it's almost as if it doesn't exist and it's a unicorn at this point. The strongest form of reasonable cause in the IRS eyes, and I'll agree that this is a fairly strong reasonable cause in the scope of reasonable cause, would be the reliance defense, where basically I knew I didn't know what I was doing. I hired a qualified tax professional and I still got it wrong. And what should I have done? Should I have second guessed my professional? Is that my responsibility to do? Meaning my job is to hire someone competent, and if they make a mistake, I have reasonable reliance. And there's a case called neonatology that outlines the standard. It's a 3-pronged approach. You have to hire someone who holds themselves out as a competent professional, and you have to give them all the information necessary to make the determination, and you have to act in good faith. Those are really the 3 prongs you need to meet for reliance. And I can tell you, I've been to appeals with clients who have, in our opinion, very strong reliance, and they had a professional. But in those circumstances, the IRS seems to be, going down to the most minutia facts and trying to parse things out, where really you look at it, it's just an unfortunate circumstance. They hired a professional and they got it wrong. And unfortunately, the IRS is taking a position that's very, very heavy-handed in those cases, particularly with the Form 3520, and we'd like to see them soften up the approach on reasonable cause. And they don't believe, that's the reliance standard, and they don't believe that ignorance is a defense in appeals, even if you consider your first time someone who just immigrated and came to the country. But in the Internal Revenue Manual, there seems to be, a large section there that discusses ignorance as a defense. But because there aren't a lot of international informational reporting penalty cases where ignorance was considered a viable defense in litigation, appeals looks at it from a hazardous litigation standard. And they say, well, not that many cases out there. Some cases are out there, are losers. And a lot of times that could be, or many times that could be, because the facts of those cases are egregious. But, they take a somewhat harsh position in appeals because of that. And it's a systemic issue at the IRS that needs to be addressed, particularly where you're talking about an inheritance or gift where it didn't result in any income tax noncompliance, and it's devastating to people financially.
Oh, it's absolute madness. It is madness. Um, on the first prong of the test, seeking a qualified professional, I'm sure you're more up on this than I am, but I remember reading one case where the decision got into whether this was somebody who was holding themselves out as having experience in international tax and international information returns. Any thoughts on that?
Correct. So that's always an important component to reasonable reliance, right? You have to show the person was competent. You can't find your cousin who says they do tax returns, 4 of them a year, and they don't have anything to do with international. I mean, I think that the IRS can reject that because that's not reasonable reliance, because you have to hire a qualified professional. So I don't disagree that that may not be a strongest defense. But in a circumstance where what I would always do is if you're post facto and you're in penalty land already, or if you're pre-penalty and you're selecting somebody, go to their website and see if they market international as an area of practice. And of course, disclose to them the gift and the inheritance. And that goes to the prong of disclosing the information to them and giving them the amounts and the dates and the source of those funds as well, so they can make the determination. And at that point, you're in a much stronger position to get reasonable reliance down the road. Or if you're post-penalty, to argue reasonable reliance, you would want to make sure that that person was not only holding themselves out on a website, but talk to them about it. And if they hold themselves, I've done so many of these, don't worry about it, right? And in that kind of conversation, I would love to have that in writing. Try to email them, because the defense attorney in me wants evidence. But, certainly the he said, she said nature of it doesn't help. But it's better than assuming that person is qualified or competent.
Right. Well, there is no question that this area of foreign information reporting, well, and the returns generally, is a clear specialty, and I think understood to be at this point. And I'm sure you would agree with that.
I agree. And in addition to that, when looking at viable arguments, you really want to put everything you can on the table. Right? And if you have a really strong case, you may want to consider what's called a qualified offer. I mean, remember that procedurally, these 3520 penalties, when you file an appeal, you end up in appeals. Appeals knows that you don't have tax court rights after. So normally when you're audited and there's an income tax adjustment, that income tax adjustment then gives you rights post-appeal to go to tax court, get an IRS attorney assigned, and there's a judge, and you get a little bit higher level of scrutiny, so to speak, in terms of whether or not you get that particular credit or expense or whatever the challenge is. But in informational reporting penalties, many of these penalties, according to the IRS, are assessable penalties, which they skip the deficiency procedures, meaning they don't give you a right to go to tax court. Go straight to appeals, and then after appeals, the case is dead. And the only way then to challenge the liability is to pay it and file a refund suit in federal district court. So you have to pay this massive liability to get your ticket in court. You got to go to federal district court litigation, and it's expensive. And I think appeals knows that. So when you're trying to level the playing field a little bit, and that's what I try to do, is somewhat level the playing field and create some additional hazards for appeals to try to settle, when the scales are so greatly tipped in their favor, is really to consider maybe doing a qualified offer, where if you offer the IRS a certain sum of money to settle in appeals and they do not accept it, and ultimately you win later in litigation, then, and there's a lot of nuances to this, but essentially they could be on the hook, the IRS, for your attorney's fees and professional fees. So it creates a little bit more, maybe, sensitivity or scrutiny. I don't know what the word you want to use.
Well, it creates a downside, to not taking the process seriously. That's how litigation works in Canada, by the way. Is that, as a general principle, you can make a payment in a court, so to speak, and if they recover less than that, then they're on the hook for the fees.
Right. So lodging that kind of qualified offer might be a strategy, but in addition to that, There's also procedural faults you'll always want to look into and verify cross T's dot I's. The IRS under Code Section 6751B has a requirement to verify managerial approval before the determination of the penalty. So because of the nature of how these penalties are being issued and somewhat automated in process, you want to certainly preserve that argument and request, either file a Freedom of Information Act request for proof of managerial approval, or preserve the argument in appeals. While you don't see that as a winning argument a majority of the time, even if it's on that one case that had a $250,000 penalty and you win on that issue, you certainly want to preserve that. So you come at the IRS with all your tools in your tool chest, as strong as you can. My real hope is that at some point the IRS softens up on reasonable cause, like they do in the 5472 context, and that's outside the scope of today's discussion. But in the 5472 context, that's inbound, so that's foreign investment in the United States can create a 5472 filing requirement for the U.S. company to disclose the foreign investment or the foreign ownership in the U.S. company. And not to go too greatly into it, penalties there are significant as well. But the regulations, it allows for reasonable cause, but the regulations say apply reasonable cause liberally if gross revenues are under 20 million. So I'd like to see some type of softening up of standards where reasonable cause, maybe under the 3520s, where it's just informational, is applied liberally and not giving taxpayers such a hard time where they're dancing on the pin of a needle and trying to get some type of reasonable cause standard that in the IRS's eyes is really a unicorn. I'd really like to see that, or maybe some type of first-time abatement where if you're a first-time violation, why shouldn't you be eligible for abatement? And of course, anti-abuse provisions, just to make sure that people don't do it on purpose and then request a first-time abatement and get it. But there's a first-time abatement process available for other types of penalties, and why not this one? I think that those are some things.
Something clearly has to be done. There's no doubt about it, because more on this in a second. But what they're not encouraging people to come into compliance. That is for sure. And in the long run, that's simply not in the interest of the tax administration in the United States. There's no doubt.